Well, it's been a busy day for consumer data with both the CPI and retail sales figures coming out. RMB Economist Isaah Mhlanga joins us now to unpack those figures. Thanks for your time today. 3.8% in March. Was that surprising?
Very surprising. I think there are three things that we need to take into account. 3.8% is the lowest number that we have seen in 7 years. It implies that consumers, on average, have been paying prices that are lower or that are growing at a slower pace than the previous month. That's one point. But I think the second point to note is that we should not expect CPI to remain this low. Okay. I'm sure consumers, when they were shopping over the past 2 weeks, they would have seen on their receipts that VAT rate has changed from 14% to 15%, which implies the April number is likely to jump above 4%, likely even going as high as 4.7% for the month of April. And the third aspect that we also need to take into account is that there's this tendency of thinking the central bank is going to cut rates that's just because the previous month's CPI surprised on the downside. That's not the case. The central bank looks into its forecast for the year ahead or even 18 months ahead and make policy decisions based on that. So if you look at the first quarter, it is right on the SARB's forecast of 4.1%, including this 3.8% that we saw today. Okay,
so you're not penciling in any further rate cuts this year. We did see one at the end of last month.
No, we're not penciling in any further rate cuts this year. In fact, if Eskom gets higher than above tariff increases that is applying for, it's likely to pose an upside risk to the central bank's inflation forecast. Also, it's on the basis of a weaker range that we forecast over the next few months. It's likely to feed through into higher fuel prices. Also take into account that we have fuel levies that also kicked in at the beginning of April. That is also going to pose upside risk to inflation. So by and large, inflation has bottomed out. From where it is now, it's an upward trend until year end into next year.
Now, last week, the central bank had said that it would prefer inflation to be around that midpoint target, so around 4.5% in the target band. What are the chances that it does do that it remains in that sort of area and doesn't breach the upper end?
It's unlikely to breach the upper target for the next 18 months. Demand pressures are still very weak. The stability in the rand also assists in terms of inflation being contained, which means fuel price and also the pass-through effects to imported products are also going to remain contained. In fact, the central bank forecast 4.9% this year, 5.1% next year. So we haven't seen any forecast across the market. Even our own forecast, there isn't any single one that forecast above 6% for the next 18 months. So it's likely to remain within target.
So does that mean we'll flatline on the repo?
That's what it's likely to mean. We are going to remain constant for the next 18 months or so.
All right, let's talk retail sales. Those also coming in. Started the year strong, and it seems they maintained that momentum in February as well.
Quite surprising as well, 4.9% from 3.3% previously. But I think there are a possible number of reasons why that is so. Firstly, possibly consumers were trying to front-run the VAT increase, which came into effect in April, so buy before it kicks in. Secondly, the decline in inflation, of course, the disinflation trend implies consumers were taking advantage of lower retail prices. And again, in addition to that, an improvement in consumer confidence. And you see that in the purchases of furniture, household contents, which tend to be more durable goods, which consumers need to be confident first before they can buy, because these are products of a longer nature in terms of how long the consumers would have to hold them. So it's a story of confidence, inflation, plus also taking into account the cut in interest rate that we got from the central bank. It's a nice boost in confidence, which implies the consumer was more confident. But once the VAT start to kick in, we're likely to see those retail sales numbers decelerate a bit to indicate or to take into account the impact of it.
We have seen an improvement in credit extension to households as well. Is that likely to hold up, given the expectation that we might see a spike in inflation?
It's likely to hold up. Remember, the banking sector also forecasts the likelihood of consumer spending.
Yeah.
And if they see confidence in the economy, also confidence of the consumer, job prospects, is no longer expectations of cuts, but possibly maintaining and keeping current headcounts, it implies the consumer is going to be in a better position to continue spending. So household balance sheet as well, they have been on the mend for the past couple of years. If you look at debt to disposable income, it has improved quite significantly, which means consumer household balance sheet are now at a better position than what we saw over the past couple of years.
We'll leave it there. Thanks for your time today, RMB Economist Isaah Mhlanga.